fixed income markets still have yields that are too low to be really attractive. MLPs typically offer distribution yields of 5 to 6% with fairly reliable growth prospects of around another 4 to 5%. So you're looking at a total return between the distribution yield and then distribution growth of around 10% a year. And that's a pretty attractive return.
How does that scenario change if interest rates continue to rise?
MLPs do compete with other fixed income products, so if interest rates rise, that may cause the distribution yields on MLPs to go up somewhat as well, although the yields are still, I think, quite attractive. But one of the many attractive features of MLPs is the distribution growth. So if yields move up because inflation's picking up, you'll still see distributions grow on MLPs, whereas with conventional fixed income they won't. So I look at MLPs as really a high yield bond substitute. I think any investor that's willing to hold high yield bonds should instead hold a portfolio of MLPs. I think you get roughly the same type of risk profile and much better return outcome.
That's where I was going next. So high yield means more risk. What's the risk factor then with MLPs?
Well, MLPs are equities, so fundamentally you have equity risk, although they're typically levered around equal amounts of debt to equity. They have debt to EBITDA of around between 3 to 5 times, so not that levered. And because they have to come back to the markets fairly regularly to raise money for any new project, it imposes a fair degree of financial discipline on those businesses, because if they're making bad investments, the capital markets will quickly shut them off or demand a much higher return on future issuance of debt.